Well, hello, everyone, and wow, welcome to January 27th Vital Talks. And we have got a super packed day, an hour of jam-packed with great things for you. If you are interested in learning about what's going on in the staffing industry, M&A marketplace, what's going on, what happened in 2021, and what you need to know for 2022, this is the place to be. So we're really excited about today's panelists. And if you've never been to a Vital Talk before, welcome. If this is your umpty-umph Vital Talk, welcome. We're delighted to have you all, whether you're a member or thinking about becoming a member. We're just really grateful you joined us, and you will be glad you came. CSP, the value proposition for Vital is V for visionary thinker, I for integrity, T for training, A for advocacy, and L for leadership. And today you are just learning about visionary thoughts and things you can do to be a leader in the industry and be very knowledgeable. And so today we have the Becker Law Group. We have Marty leading this panelist. And for those of you who don't know Marty, definitely, Marty, you have to kind of introduce yourself because I don't do you justice. And then you and Michael, you put together this great group of panelists. And I have a question, though. Is it Visus or Visus?
It's Visus.
Visus. Okay, so now everybody remember that. And then we go by UHY, correct? For UHY?
That is correct.
Awesome. So now everybody will remember that. So remember those two names. If you're not familiar with these awesome panelists, we're going to have all their contact information at the end of this presentation. And you can get some live questions answered. So, Marty, why did you put together these panelists? What can you tell us about them that you handpicked these panelists to join us? You were telling me when we were warming up that they are phenomenal, and people in the industry who don't know them really do need to know them.
Well, thank you, Michelle. Always a pleasure to be on Vital Talks and support CSP, and happy to be here today. And I'm super excited about this chat we're going to have, and the two folks who are joining me, Tom Kosnik and Dan Sporka. Tom is from Visus Group, and Dan is from UHY Advisors. I've known these two companies for quite some time because, like Becker, they truly dedicate themselves to this industry. And so I've been lucky enough to work with both Visus and UHY on a number of projects over the years, and in particular on a number of M&A projects or M&A prep projects over the last few years. So when we came up with the idea for this panel, I immediately thought of Dan and Tom and asked them to join us. And the nice thing about the panel is the three of us bring a little bit different perspective. I'm going to let Dan and Tom introduce themselves and what they do, but Becker, of course, brings the legal perspective to M&A, involved in so many transactions the past year. We're lucky to have exceeded our previous record of transactions in a year in the industry. This last year did 18 transactions in the staffing industry. So, we really understand what these M&A deals look like from both the buyer and seller perspective. And then we have Dan from UHY. Dan's an investment banker, represents, a number of sellers in the staffing industry. Dan and I were lucky enough to work on a very, very big transaction in the industry. And, he'll bring his expertise on helping owners market themselves and bring themselves to market and successfully conclude a transaction. And then Tom, Tom from Visus Group, Tom works with owners really in the prep to get to market, and which is so important, and we're going to talk a lot about. So it's really a good group, and I'm excited because we're all going to have different perspectives. And Tom, I know I didn't give your experience and Visus Group's experience, I didn't do it justice. So maybe you can talk for 2 seconds about kind of your background and the lens in which you bring to staffing industry M&A.
Sure. Yeah. You want me to do that right now?
Yeah, that'd be great.
Yeah, sure. So 27 years in the staffing industry, and we help people that own and manage staffing businesses increase the value of the asset they own, and we do that in a number of different ways. We sponsor a President's Roundtable, which is a networking group to help business owners learn about best practices and make positive, healthy changes within their organizations, help them grow it, and then specifically through a variety of services, we help them just get their finances in line, get their compensation plans in line, make sure the clients that they're going after, the ideal client profile, the professional management piece of it, the sales management piece of it, all those little pieces of the car that need to be put together well in order to have a nice shiny car on the market when you're ready to sell it.
Yeah, thanks, Tom. People often overlook some of the pieces of the car, and I look forward to talking about that a little bit with you in the next hour. And then Dan, as I introduced you, Dan is an investment banker. Dan, maybe you can give the attendees a few minutes on yourself and on UHY Advisors for those folks who aren't familiar with UHY.
Yeah, sure. So I have over 15 years of M&A and consulting experience. I really focus in on the middle market, owner-operated, entrepreneurial-owned companies. That's really my focus, and that's really UHY's focus. And so I work for UHY. UHY is an accounting, tax firm, and consulting firm, and I sit in a group that is a licensed FINRA broker-dealer that focuses on M&A. We're affiliated and attached with UHY, and really our goal is solely on M&A, raising capital, selling businesses, helping businesses buy other businesses, raising debt. And our benefit of being a part of this group is that we can leverage the knowledge and resources from a tax perspective as that comes into play, from a financial perspective. But my focus specifically is really on M&A, and I do that full time.
Well, let's jump right into it, Dan and Tom. I mean, couldn't be a better time in the staffing industry to be having this conversation. What an incredible year it was for most folks in the industry, and what an incredible year it was for M&A activity in the industry. Dan, maybe you could set the table for today's discussion by providing, our attendees with kind of a synopsis and some statistics about the 2021 M&A market in the industry.
Yeah, sure. So it was a record year in M&A. It reached nearly $6 trillion of global M&A volumes, and that's great. That's a great number, but what does that really mean, right? So you have, $50 billion deals here and $100 billion there. So what does it mean for the majority of our of the attendees? So about 24% of those are really private equity deals, and not everyone does private equity deals, but that typically can represent a little smaller segment of the population. But the activity was robust. So it was a record year. Valuations in general were up. That has a lot to do with, money being cheap. But 2021 was a record year for M&A.
And Tom, why don't you give us your perspective on 2021 and activity, valuations, whatever you think are the important takeaways about the 2021 marketplace.
Yeah, sure. It's clearly a seller's market right now. Yes, Dan's right, record number and in a lot of different categories, and deals all the way up and down the food chain, from the small owner-operator type businesses, the middle market, the enterprise level clients, the household names. We've seen some big acquisitions this past year, And we've also seen a lot of these over-the-back fence, a competitor buying another smaller competitor deal. And, what's driving that growth, 2021, what's driving that growth and likely what's going to continue to drive the growth into 2022, that, it's become much more challenging to organically grow in the current market. Competition remains high. Back when COVID started, the payroll, we thought that, gosh, a lot of staffing companies are going to go out of business. But the payroll protection program saved a lot of staffing firms. And now we've got the ERC, the employee retention credits, and that have made a lot of staffing firms flush with cash. The second thing that's driving, that drove acquisitions and will continue to drive acquisitions, the supply side is tight. And it's going to remain tight for not just a couple of years, but when you read employment data and whatnot, it's going to be several years that this candidate short market, this supply for human capital is going to remain tight. And there's several reasons about that. And I would say so it's easy. I mean, I'm talking to IT clients that are buying owner operator type IT firms, not for the client base, but for the, you got 80, 70, 75, 80, 100 contractors on billing. They want to buy the contractors. They're more interested in the resources than the client list. It's kind of crazy. And one other note, one of the complaints from the buyers is that I'm hearing, hey, prices are too high. So, Dan, I'm sure you're hearing the same thing. Seller expectations are too high. You're probably hearing the kind of the same musings out there in the M&A in the M&A market.
Yeah, I mean, I typically the last couple deals I did in 21, we ran some full processes and really had the market speak for itself. And really to add to that, driving some of the valuations, it's just cheap. There's cheap money out there, really cheap money.
Yes.
Interest rates are low. Cash, and if you're a larger company that was able to get some cash stashed away, what do you do with it? You put it in the market, or you can increase your company through acquisition. And to add to your point about resources, it's not even just about resources on the field. It's that people can't even find recruiters anymore. So how do you find recruiters? You buy a small shop with 3 or 4 recruiters and add them into your infrastructure. But yeah, I mean, we do hear the complaints about prices being up, and it's just something that from an economic standpoint, when debt and money is so cheap, that's what's really driving a lot of the prices. You can get debt, and people are being aggressive with debt. It's really a major factor, in 2021.
Yes, I mean, liquidity was to me the biggest driving factor in the marketplace, and it has to go somewhere. And I think, Tom, you did a fantastic job of outlining some of the reasons a lot of that liquidity is coming into or staying in the industry, and that is that the long-term outlook for this industry, at least for most of the sectors, is very positive. And so when you get that combination of liquidity, cheap money, and a sector that has some promise to it, you're going to have what you have in 2021. Let's look into this year, right? I mean, we're just starting out. We're still in January. Dan, what's your prediction for the staffing industry M&A market for 2022?
Yeah, let me answer that with just a little bit of some other factors of 2021 because it goes into 2022. So, we had a factor in 21 with more of a political component with taxes, right? There was a fear, and pretty much where people thought it was a slam dunk that taxes were going to be increased in 2022 for long-term capital gains. So the thought was, like, if you're going to sell in the next 2 or 3 years or 4 years, you might as well just sell now to avoid what was anticipated to be a significant increase in taxes. So you had this huge sort of pull up of deals and people who wanted to exit by the end of the year, which drove a lot of activity. Well, come December, there was really, to a surprise to all of us, there was really no tax increase. And going into 2022, although there is a risk that they could increase taxes, on an election year, it doesn't seem likely. There still is a chance that they could increase taxes. So you had a bunch of people selling in 2021 to avoid taxes. It didn't come to fruition, and so they still sold. And now you have another wave of people who are sort of got the thought in their head of, we can still avoid taxes, and let's sell in 2022, and we don't have to rush it, and we can sort of take our time throughout the year. But that is, I see the same type of momentum of the folks looking to get out coming in 2022. That does have some other anecdotal. People are tired. If you're approaching mid to late 50s and you think you have 5 years in you, the pandemic really took a toll on you, especially dealing with human capital, dealing with the lack of candidates. That took a mental toll, and people are tired, and they just want to get out, and they don't want to wait. And if they think they have to wait 5 years, they want to sort of put that in motion. So that's sort of the anecdotal and, I guess, political side of it. On the economic side of it, there's still cheap money. There is talk that there will be some rate increases that could impact valuations slightly, but just given the amount of cash on the sidelines that are looking to put money to work, I don't really. It might impact a little bit, but I don't see it making a material impact on valuations unless there's a significant rate increase. But there's just as much excitement on valuation and activity coming into 2022 than there was coming off of 2021.
Tom, how about your perspective? Do you agree with Dan? Are there certain sectors in the staffing industry that you think are better positioned in 22 than others? What are your thoughts?
Yeah, Marty, it's so how many referrals have I sent your way in the last 6 months or so? But it's so interesting. In the enterprise size roundtable that I manage, 100%, all of them are out looking for acquisitions, and now, to Dan's point, a lot of the middle market firms are out there looking for $5 to $15 million a year acquisitions. So 2022 is going to be another great year. And again, PPP money, ERC money, money's cheap if you want to borrow it, on and on and on. I mean, these staffing companies are flush with cash, so they got the money to do these deals. And I would say healthcare and IT are going to be high in demand, and predominantly due to the fact that we have a fully deployed, in those areas, we have a fully deployed workforce. And accounting and finance, to follow some of these sectors, life science and legal and whatnot, they're so small in the staffing industry overall. And then of course we're going to continue to see the commercial staffing continue to sell and whatnot. But yeah, I'm seeing I'm hearing a lot of good things. We have a lot of clients that are asking about, hey, do you have the clients that are interested in selling and whatnot? So I assume that, it's going to be another good year for 2022.
One comment you made, Tom, that I absolutely agree with, and I think makes this market a little bit different than any of the markets I've seen over the last 15 years in the industry. And that is kind of the breadth of the people in the marketplace. And you talked about the whole food chain being in the marketplace. It's really true. I mean, past hot markets that I've been on in the industry, it was still just a segment of the food chain that was in the M&A marketplace. I have so many smaller staffing firms that are calling me with acquisition candidates than I've ever had before.
Yes.
So it's not just the enterprise folks. It's not just the upper end of the middle market that is involved in today's M&A marketplace, but you've got activity at the very smallest points of the marketplace as well. So I tend to think, through the first half of the year, for sure, I see this marketplace staying as hot as it's been. Dan, let's talk a little bit about valuations themselves. Obviously, they rose throughout 2021. Do you see valuations in this industry plateauing a little bit? Do you see them continuing to rise? What do you see in terms of valuations in 2022?
Sure. I mean, I would say at a high level, they're going to continue to rise, especially if interest rates remain low or there's minimal changes or they sort of stay as the increases are to be expected. But I think it's worth digging into, as Tom was alluding to, the sort of the submarkets itself. Healthcare, for example, as much as the pandemic exposed the need and really pushed that sector. Behind the scenes, there is fundamental long-term dynamics that's driving the growth of an industry. You have aging population. You have nurses and doctors that are approaching retirement. And regardless of pandemic or economy, those are dynamics that are not changing. And so to truly look at valuations, you look at the subsector. So healthcare would be one that, regardless, has some tailwinds that are going to be pushing it for the near future. And then IT again itself, and as manufacturing and commercial comes back and people are in the office, I think there's probably some opportunity to buy some candidates there that are ripe for some really growth as people return to the office and return to restaurants but right now healthcare is really having its day.
We got our first question, and attendees really encourage a proactive webinar here. So please fire away with your questions as we go. But I saw a question come out, and Dan or Tom, if you want to handle this. The viewer agrees that money is cheap today, but they have concerns about inflations and, as you mentioned, Dan, interest rates going up. How big of an impact do you see those two factors being on the marketplace and potentially cooling the marketplace?
I'm not an economist, but this is just my read on it. Is that these increases are expected. They're going to be, they will try to maintain some inflationary impacts here. But the other main driving force here is that there's just so much cash. There's cash on people's balance sheet. There's access to cash. So if you talk about interest rates on a quarter point, moving up a quarter point, it's still cheap. And even if it moves up, it's still going to be considered cheap. So it will. I mean, it will have an impact on value, but I don't think it's going to be a major shift in the value dynamic where it's going to start eliminating people on the fringe.
Yeah, I would agree with. Yeah, I would agree with that. A minor increase. I mean, we know that the Feds are going to increase the interest rates. It's going to affect the housing market more than companies buying companies. Dan's spot on. I mean, the balance sheets of these staffing companies have never looked better. Money still is going to be relatively inexpensive, and there's going to be a lot of deals out there to be had. And the inflation thing, that's going to taper off. I mean, for several reasons. There's some economists that I follow, but the inflation thing it'll taper back down to that 2% and at some point during the year. And this is economics 101. You can't dump $4 trillion of cash into the economy and not expect inflation not to happen. I mean, it just has to wash its way through the system.
Then we got another great question that came in and fits in with what we're talking about. Wanting us to comment on how current deals are panning out, and more specifically, what are we seeing in terms of the buyer strategy? Is it really strategy driven, or is it more of a pure, growth or market share grab? Dan, you want to talk about that first?
Yeah, I mean, it's across the board. We have private equity firms getting into a space they feel is a dynamic space as a platform company. We have strategic buyers looking to take over regional presence, or to bring on recruiters. And I mean, and that's a good thing, right? The more types of buyers and the more pools of buyers that you can appeal to in the marketplace, the bigger pool of buyers just drives competition and drives value. So we see it across the board. The deal, Marty, you and I worked on, we had strategic players, we had private equity players that had a platform that they wanted to expand into a region. We had private equity folks that wanted to bring it in as a platform. So we had all the types of buyers.
Yeah, we absolutely did, and that is really that deal was, to me, a good, kind of indication of the marketplace and the buyers that are out there. It surprises me, but there are just so many buyers that are and it's I'm not saying it's not a smart strategy, but that are leveraging cheap money and leveraging aggregation, right? They're using cheap money to aggregate, and so that is a strategy of many of the buyers, but you see the strategies across the board. Some that are very long-term strategic, others that are leveraging cheap money to aggregate to sell in the short term. But the bottom line, as you said, Dan, is there's a lot of buyers out there, and of course that makes for a good marketplace.
Yeah, let me add this too. Sorry,
go ahead, Dan.
One dynamic. I mean, there is a pretty significant shift in the market with technology. The Uberification of the sector, with significant investment on the tech side to deploy employees. So you have this other dynamic there that are sort of tech-based, either solely tech or tech with staffing in it, looking to buy up more, I guess, historical, people-heavy, recruiter-heavy companies to roll them into some kind of tech platform. So there is a dynamic lurking there that has really been, especially with over the past 2 years, to deploy people quickly and to use less overhead out there as well. That's really moving the marketplace.
And one more comment on that, because I think that is such an important point. That changes the multiples, because those folks believe that their enterprises are not going to be valued as staffing firms, right? They believe that their enterprises are going to be valued as technology platforms, which is a completely different valuation standard. So because they believe that, they're willing to pay higher EBITDA multiples, because they don't believe they're subject to EBITDA multiples themselves. They think they're subject to tech multiples. So I've been involved in a couple deals where those technology platforms are acquiring, and they're very unconcerned with EBITDA multiples for the most case. Tom, you were going to add something?
Yeah, I was just going to say, I believe the question was quote unquote buyer strategy, and I'm assuming that the people that are on the call reflects the industry. Being that 80% of the industry or so under 10 million in revenue, and middle market and all that stuff, but a certain percentage middle market. But buyer strategy, look, first off, you have to have a strategy. Your company has to have a strategy. And anything, you shouldn't be doing acquisitions if you don't know how to do it and you don't know how to integrate it into your organization. And so, but that buyer strategy, number one, you got to have your company's got to have a strategy, and then whatever your acquisition approach is, whether you want to just organically grow into, keep doing the same kind of staffing that you're doing, but you want to organically grow into, or you want to acquire into new markets, whether you want to buy into new niches. We all on the call here have seen companies that have done that. But then the other piece of buyer strategy is you've got to be highly focused. If you go into this acquisition adventure willy-nilly, opportunistically, let's look at this, let's look at that. I just have not seen a lot of success in that. I've seen a lot more success with business owners being highly focused and knowing exactly, what they're looking for and what they want to accomplish in an acquisition.
I'm getting a lot of questions about valuations. What is the method that is being used as the most common metric for determining valuations? Dan, maybe you can talk about that. What is the most common method for determining valuations in the staffing industry right now?
Yeah, so I mean, listen, people throw around multiples all the time, but really what those multiples represent is a discount on future earnings and the risk associated with that. So, without knowing specifics of a certain company, whether they have customer concentration or, whether they have hyper growth, I'll just give you some guidelines. If you have a company that is in super growth mode, and you're looking, and there is reasonable support to see, your new customers that you gain in 2021 double your company in 22, you're going to get a high multiple. You're going to get a high multiple. If you've been flat or chugging along, growing with inflation over the past 5 years, you're not going to get as attractive as a multiple unless you can really illustrate growth. And so there's not really specific guidelines as to multiples. I've seen 5 to 12 in middle market companies, and if you're growing a lot and you've proven your growth method, and there's support going into growth in 2022 and 2023, and your processes are in place and you're diversified, you're going to get a higher multiple, and you're in an attractive industry. But I'd hate to throw out, a pretty narrow range for so many subsectors, so many different variables. But, obviously happy to talk to people about the specifics that are driving growth with their specific company in the future.
Hey, Dan, just a quick question here. So you're talking about a multiple on EBITDA, and everybody understands EBITDA. Have you seen much? 2 questions. First one: have you seen much a percentage of gross profit production? 3/4 of gross profit, 1 times gross profit, 1.5 times gross profit. Have you seen that valuation at all?
So Tom, that's it's a good point. I would say that the sizes of deals that I get involved in tend to be, I would say $10 to $80 million of enterprise value. And when you start moving up that size of deals, the infrastructure at play, the SG&A at play really supports an infrastructure that is driving more of an EBITDA multiple. But when you start getting to that smaller type of transaction value, or owner operator that's probably under $15 million, that's where you can see a lot of those types of multiples used, the gross profit multiple or the revenue multiple, because those are probably more or less looked at from a strategic point of view. And so you can play with those multiples and those types of multiples more for those size of deals.
Yeah, Tom, go ahead.
Just the other question was, years ago we used to see, give me 3 to 5 years of financial history, and then they take 3 to 5 years and they average it out, and then they a percentage, a multiple of EBITDA on that. Where I'm seeing more, hey, we value based on a trailing 12 months. So Dan, just what's your experience in terms of being trailing 12, trailing 36? What are you seeing there?
Well,
in the different sectors or the different
as an advisor, as an advisor, I look to position whenever it's going to maximize value. I would say typically what the market looks at from a value perspective is going to be trailing 12 months. Now, if I can prove that the trailing 12 months is lower than, if I can bring that trailing 12 up by averaging it with historic periods, obviously I would position that to the buyer universe that, hey, 12 months was impacted by X, Y, Z. I would say the first thing to go to is the trailing 12 months as a multiple. But really, what's driving the multiple is how you can prove out the growth in the growth in 2022. So if you had a high growth 21 and your run rate in Q4 of 21 is significantly higher than your run rate in Q1 21, then I could really position your company for a higher multiple, because 22 is going to be driving off that Q4. And that's the type of positioning that I work on the most, is to drive on the future and to really position the company for growth.
Great stuff. Great. Yeah. Good way to be thinking.
Let me jump in on a couple of those points, Tom. Really, COVID threw out the longer trailing 12-month periods. I mean, like Dan is right. Sometimes you have a story to tell, and so you're ignoring the trailing 12, or you're adding to the story of the trailing 12. But once COVID came around, and now we've been outside of the beginning of that for 2 years, now folks are really focused in on trailing 12 months, unless you have a really good story as to why it should be looked at as something else.
Tom, I'll give you
it was so refreshing to hear Dan talk about growth, because so many investment bankers talk about just multiples of EBITDA and just segment companies based on, healthcare gets, 7 to 10, and IT gets 6 to 9, and commercial gets 4 to 6. And
does that include working capital, not working capital? Anyway.
But the story is every major deal I've done where somebody has blown it out on their multiple is because of their growth story. I've seen it in 2 or 3 IT staffing deals over the last 2 years. I've seen it in 2 or 3 healthcare staffing deals over the last few years. I've seen it in professional deal. I've seen it in a commercial deal. Folks who have a tremendous growth story are just the ones who are blowing out the multiples. And so anybody, who's attending on this call, looking towards, exiting, to me, I agree with Dan 100%. Your growth story is the most important story you can tell. And it's not just, have you grown? Obviously important. Do you have a track record of growth? Important. It's also your story about the future. Is it believable? I have a client who sold post-COVID about 9 months ago, had an incredible growth story, but the buyer was concerned if it was just COVID inflated, right? So my client had to spend a lot of time making sure that they could demonstrate that it was a sustainable growth story, and what the actual factors before and how they would multiply. But to me, Dan is 100% right. Growth is the most important factor.
I think,
Tom, let's go ahead, Dan. Sorry.
I think there's a misconception that, historical data is like the driver of value, when really you got to look at it as a two-step approach. People look at history as an indication of the future. And that's the safest way to look at it. But sometimes, and a lot of times, that's not necessarily correct, right? So if you can take that as a baseline, but then come up with a storyline to where the history is not going to represent the future with growth, it's really driving, the value is really driven off of how you can prove out growth.
Tom, you work with folks on growth, right? I mean, I know that we've referred a number of clients to you to work with you. Talk about growth and growth plans, and share some stories about how they may have translated to an exit down the road, if you have any that you think are relevant to share.
Sure, and I this sort of the Achilles heel of the industry is client concentration, and as many P&Ls that I've looked at, these companies that are 15 million and under, it's almost the same story. You've got 1 to 3 clients that make up 80% of the revenue, and so one thing about having a growth plan is to make sure that you have a good portfolio of clients, client diversity, that you don't have one client representing more than 15% of your overall revenue. I had a client one time that 90%. I mean, it was an amazing, profitable company. But they had basically 90% client concentration and 30 million in revenue. We couldn't even get anybody to look at them. I mean, it was crazy. But I'm sure Dan has run into this as well. Marty, you've probably seen this as well. But it's like, well, you don't have a company, you have an account. we'll buy an account. The other thing with a growth plan. So the growth plan has got to take into account the kinds of accounts that I'm going after, and which is basically the sales plan. And as many times we see, do you have a true sales funnel? Do you have a true ideal client profile? These are sort of on the sales side of the house. These are the things that really you have to execute on in order to not fall into that client concentration issue. And the other thing about a growth plan, and planning just means that you're thinking it out. Whatever the key challenges are, you're thinking out, and you're positioning your next moves so that you don't fall into these traps. And another trap is falling into below average margins. If you got below average margins, it's just you're going to attract a lot less buyers. But if you have average and above average margins, you're definitely going to attract more buyers, and obviously the valuation is going to be higher. We had a client, a middle market client, 25 million in revenue. Most of it, they were on the technical side of the house, and they were predominantly at that 8. They were on the lower end, so they were 18% gross margins. But we got the management team together, the owners of the business, put a game plan together, put a sales plan together. It was all geared towards moving them from 24% gross margin. And these guys were sharp guys, but they fell into this lower end margin. That's what they got started in, and then it took over the business. But then they wanted to up that they wanted to get that gross margin up to 24% so they could sell the business at a certain multiple. And so we put a balanced scorecard in place, and hats off to them. 3 years later, we were able to move those margins from 18 to 24%, and they successfully sold the business for what they wanted to. And just the last piece of it. And Marty, I don't know how many times you and I have talked about this with some of the clients, and that is just having a solid. And this is all part of. You can put a business plan together, but that business plan has got to be backed by some kind of a financial model. And the financial model really needs to fall in line with SaaS industry standards. And so your back office expense, your sales expense, your recruiting expense, that as a percentage of your gross profit, that they're in line with industry standards. When they're out of line with industry standards, it's definitely going to affect the valuation. But those, yeah, yeah.
I think that the margin it was a good thing to add in at the end of this part of this conversation, because that does impact growth. I think is the most important factor, but having margins that are at the industry standard or above it also impacts your sellability. We got a question in. I'll throw this one to you, Dan. A lot of sellers have balance sheets that show a lot of cash because of PPP loans being forgiven, or a lot of cash because they participated in the retention credit program. Are buyers factoring that in at all in terms of valuations and looking at sellers?
Yeah, so typically industry standard is that deals are completed on a cash-free, debt-free basis. So any cash on the balance sheet and long-term debt, from banks, or if you have to owe it back to the government, that's really netted for you personally. So if you have $2 million on your bank account, that's yours, and that's not included in valuation. Now, as far as taking PPP income, so if you got $1 million of PPP and on your balance sheet, or on your income statement, you took $1 million of PPP income, that would be removed from income, and you would not get credit for that as far as the ongoing operations, but you would be able to keep the cash that's on your balance sheet typically.
Yeah, that's been a sweetener for a lot of sellers that I've seen that are getting a good multiple offer and a good valuation, but then on top of that, they've got extra cash and they're being able to take that off the table and put that in their pockets themselves, and that's led to what has been a very lucrative deal for a lot of our clients who are sellers. I want to move a little bit to preparing to go to market. Tom, let's talk about some common steps that you recommend, folks who are in the industry looking to exit in, the not too distant future. What's some advice you would give about common ways they can prepare to enter the market better?
Sure. Yeah. A seller wants to prepare their organization to be the shiniest looking apple on the apple cart for potential buyers to pick up and want to buy. The pundits will say, hey, an exit strategy, you need to start 3 to 5 years in advance. And when we think about 3 years, I mean, just listen to what the conversation we just had on valuations and trailing 12, one side of the coin, growth on the other side of the coin. So you're going to need a good runway or a couple of years runway of growth in the organization. So 3 years seems like a long time in today's day and age with technology changing so fast. But we get calls. Well, we just took that one call, Marty. We got a call in December, and they wanted to sell in January. Good luck. We're the wrong guys. We're not magicians. But anyway, so one thing that sellers to prepare, exit strategy in place. And then that exit strategy, you have to think through all those key variables that we talked about. Get your finances in order. Make sure you're working away towards no client concentration, that you're working towards average and above average gross margins, which is cutting the unprofitable clients and securing a good, healthy clients. A big one that we haven't talked about, which is a stickler, and that is management in place that will go with the acquisition. So a lot of firms, the owner of the business or family members are in the business, and those family members are tied to key accounts and whatnot. But having management in place, if you're middle market or you own the business and you've got too much tied to you, not an attractive type of a thing. And buyers do. It'd be interesting to get Dan's thought on this, but I find that you have 4 or 5, half a dozen offices versus, I'm a one office operation doing X amount. That if you're a regional organization and you're in a half a dozen different cities, those are you can generally pull in the buyers that are north of 100 million in revenue. They've got the cash flow. They know how to do deals. They've done deals, that sort of thing. And just running, we've all heard that statement, run your business as if you're going to sell it next year. Well, that's just being smart in your business. I mean, don't have vacation houses in the P&L. Don't have too many kids that aren't doing anything, in the P&L. Just run the business financially smart. Get your books audited every year with your accounting firm. And then the other piece of preparing to sell, and I've seen this so many times, and that is you need to build relationships with attorneys and finance folks that have staffing industry experience. I've heard people say to me, "Hey, isn't this just like selling a house?" No, this is not like selling a house. This is much more complicated than that. And but yeah, tax attorneys, attorneys that know about LOIs and non-compete agreements and asset purchase, stock purchase, all that stuff. It's gosh, oh man, could I tell you a couple of stories where people were represented by either brokers that had no industry experience or by attorneys and accountants that had no industry experience. They left so much money on the table.
And Tom, just to add, you mentioned something there is non-competes. Make sure your recruiters have non-competes and industry standard non-competes, because you might have a relationship with them now and it's sort of a handshake. And it's been like that for 10 years, but when a buyer comes in and they start looking at agreements and you don't have, your standard, Marty, more than I would, about a year long non-compete, you're going to run into some issues.
Restrictive agreements, man. That's a whole nother, that's the next webinar. The internal employee side of things.
No, I'm going to tip my hat to you, Dan, because the deal that we just did, you focused in on this, I believe, 6 months before the company went to market. And you focused in right where you should have focused in. You focused in on the company's top revenue producers and top revenue protectors, right? And you forced the client to come up with a strategy of how they were going to do two things. One, secure that talent through the end of the transaction and into working for the new company, and that was through, covenants. And two, motivate them, reward them, right? For what was for helping build the company, and give them potential rewards for moving over. And so many folks forget to look at that until, a week before closing, right? And it's too late. It's too late. And the stories of big producers walking out, a week after a deal because they're not happy with their new home and they weren't treated right and they weren't secured. I can tell a half dozen stories about that in the last couple of years. So,
or
really,
worse off if they walk a week before the deal and it destroys the deal.
We've all seen those stories, all seen those deals.
Dan, talk a little bit about the mistakes you've seen. Obviously, we just talked about one, and that's not securing your talent. But talk about other mistakes you've seen folks make in going to market.
So as much as it's perfect to have a 3 to 5 year plan, I mean, there's opportunities that come up. You're approached. There's a health issue. There's a family issue. And sometimes people just don't have the opportunity to wait or to prepare for 3 years. So, some of the mistakes is, missteps that we've seen, and it's already been mentioned. I just want to sort of refocus on it is, making sure your financials are clean, that you're looking at closing your books monthly, that you have some documented processes and protocols in place for a well thought out commission plan that's documented. These are all things that just sort of represent a company that is well organized, and then a buyer sees as less risky. That compensation is defined. That you have, even if it's a small company, that you have levels in place that are in an org chart. And listen, there's plenty of times where I'm brought in to sell a company and they don't have a budget or projections or an org chart, and that's fine. but we just have to work on it and come up with a thoughtful strategy. And again, it's helpful if it's 2 or 3 years out, but most of the time I'm working with the business owner to come up with a strategy before going to market, and that's can be a month or 2 months, or bringing Tom in to help with that. So it's not something to be concerned about, but the more you can think about projections and customer concentration and getting contracts underway and getting your advisors in place is really where you should be focused on. And I see a question out here, just sort of add to that about what about the growth strategy? When if you have a nice stable couple years, that's fine. And I think the focus of getting these high multiples was really about these high growth companies, but the really beauty of what I help with, or what Tom helps with, is that it's great if you can prove out your growth, and it's great that you can show actual growth, but most of the time it's really trying to come up with a story that is a reasonable assumption where a buyer can say, hey, I like that growth story. Of course, they'll ask, well, if it's so easy and you came up with it, why didn't you do with it? Well, maybe that owner didn't have the financial risk profile to invest in new recruiters or a new office that maybe a larger organization would. But it's really telling that story that, hey, we have a great opportunity in we're based in Detroit and we have a great opportunity in Grand Rapids. Well, why didn't you do that? Well, because I don't have that risk profile, but I can help you get there. And it's really about that growth story that you can help show buyers is really the important part to get to those multiples.
That's a good
Marty.
point.
Yeah.
Go ahead, Tom.
Yeah, just real quick in terms of mistakes, and this would be that I've seen, and this would be on the buy side and the sell side, and that is synergy and ethics. So a seller is never going to sell a company to somebody that they don't have a sense, where there's some sense of synergy, some sense of a cultural match, somebody that they can trust, that they feel that's ethical. And it's the same thing with the buyers. The buyers don't want to buy somebody that they think that there's not good synergy there. And so often I see buyers and sellers, how much you think it's worth, or how much you want for them, how much you want for your business, and they jump for the money way too quick. And on both sides of the coin, I advise. I say, look, your job in the first few weeks here is to build synergy, get to know these individuals, and is this somebody that that's like you, has the same kind of culture with you? Because why do acquisitions go sideways? They go after the acquisition, because a company that has acquisition going east buys a company that has a culture going west, and there's a complete cultural mismatch, and then what happens? You lose 2/3 of the employees that you bought. So
yeah, and Tom, to add to that, just as a mistake that people make, if you think that you're going to wipe your hands clean of the situation day one after you sell, you're in for a rude awakening. So just as an expectation and as an expectation setting, whether you plan to retire, whether you plan to cash out 100% or 50% or 80%, you should really expect to be involved in some kind of, from a transitionary period to even running the company. If you want to stay on board with a private equity firm, you should not expect to get out day one. There's been times where that's the case, but you should at least look at 1 year at the best situation to a good 2 years. Doesn't have to be full time, but you should really think that you're going to be somewhat attached to this.
Yeah, because there's going to be an earnout component, and you want to influence that earnout in a positive way.
There's almost always going to be an economic tail to these deals, whether it be an earnout, a note, rollover equity. There's always some type of economic tail, and so
right.
you want to maximize that tail for yourself, and you're going to be involved in the business post closing, most likely to maximize that tail. Well, Michelle, we've just talked through the time limit here, so I think that Dan, Tom, and I are also passionate about this particular subject. That I lost track of time. I apologize, but it's 3:02.
No, I was interrupt. I was going to interrupt, but I couldn't do it. I just couldn't do it because it was so good. Every time there was like just a tiny pause, you'd go into another area, and everyone already, normally we leave 15 minutes at the end for Q&A, but you were doing the Q&A as we go along, so it was beautiful. It was perfect. And I changed the slide so everybody can see. Martin Borosko is Marty. That's Marty right there that you've been listening to. His contact info is right there. And then Tom Kosnik, his contact info from Visus is right there. And then Dan Sporka from UHY Advisors, also right there in front of you. If you don't see it because you're driving or you don't have the slides up, you definitely will be able to get copies of these slides, although this is the best part of the slides, right here, because this contact info. They did audio presentation and really got into it. If you're just kind of joining late, you missed all the good stuff in between, but the good news, it's recorded. So you'll be able to go back. If anyone has any last burning questions, this is the time to put it through live now. But I have a question for all you gentlemen. If someone, I'm going to go back. If someone has a follow-up question like it, or they listen to this recording and they get an idea for a question, not trying to put you on the spot, but they can just reach out, right, and just say, I have another question and follow up to this panelist event. You'd answer that without starting the clock ticking, wouldn't you?
Michelle, for CSP, we're always willing to answer post-webinar questions without sending out a bill. So from the Becker perspective, we encourage it because we love to help educate folks in this industry. So please reach out if you have any further questions for us.
Okay,
and
CSP is the magic word.
Same way.
Okay, so remember that, people. CSP is magic word. Mention CSP, and then also for anyone who again isn't familiar, and you should be, with Marty and Becker Law, they will help you. As you can see, it's very holistic. You might want to go back and listen to November 11th. Becker led a talk on accounting and mistakes you don't want to make for your firm that can also help you with all of this. It's very holistic. Marty and Becker, they put together information for prevention, for defense, and for planning, so they can do the whole thing. And you definitely want it right. You want people well informed, and they put their money where their mouth is. They really actually do welcome. People have said, "Wow, I reached out to Becker, and they really did do that. They just helped me." So they want to be your partner, and they've been the best partner. I'm one of the best partners CSP members could ever imagine during this whole pandemic. I think you did our first Q&A in Vital Talks, answering questions during for the PPP. You just jumped on. You actually offered. I'll help. I'll answer those PPP questions. You've been phenomenal, Marty. We cannot thank you and Michael and all the rest of your team enough. Just can't. So remember that, people, when you're looking for some advice. And then I'm just going to quickly show a few things just to remind people. I heard a rumor that Becker Law, someone from Becker Law, I don't know who was telling me this rumor, they might actually come to conference. So you might actually get to meet these folks there. The conference is June 8th. Is that true, Marty? Or like, is someone just pulling my leg?
No. I mean, I haven't been out to our California office since COVID, but it's time for us all to get back out to California. We used to be out there regularly, and it'd be nice to see people face to face again that I've met in the past, and new people versus always doing it on Zoom or over the phone. So Becker will be out there and will be sponsoring the annual conference this year.
Wow, that's so awesome. Okay. Do you golf? Do you play pickleball? Do you hang out at the spa? All of the above? Well, everybody, this is something you can do, and you can meet people at Becker. And you know what, Dan and Tom, you're welcome to come too. Just not putting you on the spot. You can join us, and it's beautiful there.
I'll talk to Marty. I'll talk to Marty.
Yeah, me as well. Thank you.
Awesome. And so next thing is all the things that are happening at CSP, and we would love to have you all back. You have been just a wonderful panelist group, one of the most dynamic. You never took a breath of air. It was amazing. And you're always welcome to join us on our open forums too. Just you can kind of listen in, and if you want to add something, because that's open to members and non-members. So the upcoming things are, we do have a very special event. It's not going to be recorded. It's a California COVID employment law update. One of our partners, AALR, is going to be presenting on that. White House issues, they quickly put together a program for us, because as everything keeps changing. I just saw something yesterday, something new. So that's coming. And also I will mention Becker's in multi-state, right? You're in California, New York, New Jersey, and Pennsylvania. But you know the multi-state law format, not just in those states, but other states as well, right, Marty?
My partner Chris Letty keeps, I call him the chart man. He has hundreds of pages of charts for all of the staffing laws that affect our clients across the country. So not me, but if you want to talk about employment compliance law, you call Chris and he'll pull up a chart for you. Awesome.
Okay, well, and then the next open forum we have is February 24th, and that's at noon, lunch and chat. And then Silicon Valley has an employment law update. Yeah, there's a pattern there. We have a lot of laws in California, and And then June 8th through 11th, got to mark your calendar, people. So we have gone over, but it's been phenomenal. Marty, Tom, Dan, cannot thank you enough. I'm going to back up just one more time. Show those contacts. If you take a picture with your phones, people, so you get that and put that in your phone. Thank you so much for joining us. We really do appreciate you and all the information you shared. And I know I will go back and listen to this because there's so much to digest. But the things that you shared are invaluable. It's not too late to put your business together now, is what I heard. And it's going to be, now is a great time, but a year or two from now is probably great too, or even 3 to 5, maybe. They put together the right package, right?
Amen.
We can help
Amen.
you either way.
Either way. All right. Okay, well, everyone, thanks again for joining us. CSP members are doing today what others will be doing tomorrow for best practices, because we're all visionary thinkers. So thank you, and join us next time on February 3rd and then February 24th, and take a look at conference and all the other events at cspnet.org. Take care, and again, thank you, Tom and Dan and Marty and Michael.
Thank you.
Thank you.
You're very welcome.
Signing off.
Bye-bye.
Take care.